This is not financial advice. I'm recording my thoughts about Atlassian, ticker symbol TEAM. It's currently trading at about $232 with a market cap of about $60 billion. Atlassian is a company that makes software products for teams to collaborate. If you are a software engineer, you would have dealt with Jira, and Jira is a product of Atlassian. Atlassian continues to make more and more products, and they also have a developer platform. In other words, individual developers can go to Atlassian's platform and make products for Atlassian's customers. And if these developers can manage to sell those products to Atlassian's customers, Atlassian will get about 20% cut from that money. The business model seems really good. The most impressive thing that I found about this company is that this company is growing at more than 30% even in the current environment and has gross margins in the order of 85%. That is absolutely amazing. It is extremely hard to grow at this pace and make gross margins like that. Google and Adobe makes this kind of gross margins, but they're not growing even close to what Atlassian is growing. So it looks like Atlassian is an amazing company that is growing at an extremely high pace and extremely profitable company. So if you're a beginner investor, you would say, okay, the stock is trading at about $232 and I'll buy this stock at this price and it's going to go to $1 million and I'll become a millionaire, right? But this is one of the worst investments that you can make at this point, and I'm going to explain why. If you are a serious investor, you would also focus on two additional metrics. One is valuation, the second is business model. Let me first talk about the business model of this company. Can they grow at the same pace and make same gross profit margins? That is the question that we need to answer, and for that we need to dig deep into the business model. Atlassian CEO recently said they cannot achieve the same 85% gross margins anymore because a lot of their customers are migrating to cloud, and there are more hosting fees there, and then you need additional personnel to cater to the transitions. So the CEO said in the short term, they cannot achieve this 85% anymore. The gross profit margins are going to significantly struggle, but he did not give the actual number. And he's saying that as soon as all their customers migrate to the cloud, these gross profit margins can improve, but they cannot get back to that 85%. So we do have confirmation that this company cannot maintain its gross profit margins. With respect to the revenue growth rate, as you grow bigger and bigger, it's hard to grow at the same pace, right? So 30% is actually a very significant growth rate. And when this company gets bigger and bigger, like maybe like $5 or $6 billion of revenue, it's hard to grow at the same pace again. In conclusion, with respect to the business model, we have the evidence that this company cannot maintain its 85% gross profit margins. And on the other side, we have no evidence that this company can maintain its 30% growth as it gets bigger and bigger. Now let's talk about the valuation metric. This company barely makes about $2.9 billion of revenue and has a market cap close to $60 billion at this current price. And that's price to sales of more than 20, which is expensive. So I cannot make a judgment on the price to sales itself, so I need to see its evaluation in 2027, like 5 years out, to see where this company would be so I can make an investment decision. So for that, I'm going to make an estimated growth rate of about 25%, which is hard to achieve because right now if they're growing at 30%, as they get bigger and bigger, they cannot achieve the same growth rate. So 25% in my opinion is still conservative. So if I go with the same 25% growth rate, this company would make close to $9 billion of revenue in 2026. From about $3 billion now to $9 billion. That's almost 3x, right? So the assumed net profit margin would have been 35% if they could maintain 85% gross profit margins. And the CEO said they cannot achieve the 85%, right? Because of this hosting fees and migration to the cloud. So I'm going to assume that they're going to make net profit margin of about 25%, which is based off of 70 to 75% gross margins. If I assume this 25% net profit margin, this company would make about $2.2 billion of net income in 2026. For a company that is growing in the 25% range and has a 25% net profit margins, I can assume only 25 multiple, but I'm going to be more optimistic and say 27.5 multiple. So this company would be worth about $60 billion in 2026. Now let's look at the outstanding number of shares. In the past few years, the number of outstanding shares did not increase much. This company had no reason to dilute investors, but now they only have about $1.5 billion of cash and $1 billion of debt. This $1.5 billion of cash can get burnt out in the next 2 to 3 years, because remember, this company is still not making profit. Somebody has to pay for the loss, right? So to be optimistic, I'm saying that this company will not dilute the shareholders at all. So I'm still going to assume the same 253 million outstanding shares, and the stock price would be worth $240 in January of 2027. Right now they're at $232. That's almost no gain in 5 years, right? So if you invest in this company, I would love to know your thoughts. Are you thinking that this company would make $100 billion of revenue in 2028? Or you think this company can make 40% net profit margins? Would it deserve a 100 multiple like Tesla? So I would want to understand your thoughts, because I'm interested to know what your investment thesis is. So if you can show your investment thesis, maybe I would get convinced to put money in this company, right? So we're here to learn. So if you have different thoughts than me, please put your text in the comments so we can have a healthy discussion. But at the moment, with these numbers, I'm going to stay far, far away from Atlassian.